And we also know that when you raise interest rates like they've been doing, typically you don't see the effects of that for about 12 to 18 months. And so now we're about 14 months in. So by October, November, we're going to be right in the heart of that. These meme stock investors buying GameStop or Bed Bath & Beyond, they're just kind of YOLOing in and not really understanding market dynamics. And so, they're buying anything that has AI related to it. NVIDIA, for example, I mean, it's been going up like a rocket ship. It's, 80 or now maybe close to 100 times earnings. Like, in a 5% interest rate world, how does that make sense? It doesn't. So it's very hard to be like a fundamental investor in that environment. I mean, a lot of smart people I know are thinking it's time to start shorting NVIDIA because it's just like, it just makes absolutely no sense. Of course, many great investors have lost their careers trying to short juggernaut stocks like that, like Tesla, for example. So it's really not just tech stocks. It's the tech stocks that are related to AI. AI is the hottest thing in the world going right now. And so it makes a little bit of sense. Now, to the second question that you're asking, could we see another market crash? We certainly could. There are 6 or 8 big bombs or, black swans or maybe gray swans that could go off in the market at any time. And so it's going to depend on, do these blow up? How severe are they? And what can they do to counter them? So for example, we're seeing like the economy still looks like it's doing pretty good. The businesses are still reporting pretty strong earnings and sales, surprisingly. But we can see consumer debt is going through the roof and consumer savings is plunging. So that doesn't look super sustainable. It looks like the consumer is about out of money. University of Michigan does the best survey, and they do a sentiment survey to see how people feel, and it's the lowest level it's been. People are like devastated and think this thing is going to crash. So that's not good because then people stop spending when they're in that type of mood. We know that the commercial real estate market in the United States is just absolutely hammered. Nationwide, about 1 out of 5 offices are not paying rent. In some cities, Washington, San Francisco, New York City, it's like 50%. And that's $2.92 trillion. $3 trillion that could just blow up like we saw in the mortgage-backed security market in 2008. We have this situation where the Fed continues to raise rates, as we already talked about. We think there's more coming, and the Fed has basically made themselves go broke. So when they have profit, they send that to the Treasury, to the government. Well, now they're broke. They have no money to send. Now they're having losses. So now the Fed went broke. The Treasury went broke. So the Treasury has now had to borrow $1 trillion just to get through the first quarter of 2023. And that's only accelerating. And now they have to suck this liquidity out. We're going to see more banks collapse. So that's a big problem. Obviously, the war with Russia, China, Ukraine, that is big bombs that could go off in the economy. And then, it looks like if this plays out, kind of what I'm expecting sort of my base case to be is that we see them continue to raise rates. So they're tightening. At the same time, the Treasury is trying to refill the TGA. So what happened when they did that last time in 2019 is it led to the repo crisis we saw in September of 2019, where the banking system locked up. So if the Fed was tightening and the Treasury was filling at the same time, we're going back into that. The bigger problem is that in the United States and most of the developed world, all of our loans are written on an interest rate that's set by LIBOR, which is the London Interbank Exchange Rate. In the United States, we moved all of our debt to the SOFR rate, which is Secured Overnight Funding Rate, which is set by the repo market in the United States, the Federal Reserve banking system. So we just moved all the debt over. But if we get back to the same problem we had in 2019, where the Fed is tightening and the Treasury is filling and the repo market locked up, rates went to 10% overnight. If that happens and trillions of dollars of debt gets reset, that could be a big problem. And then that would force the Fed to pivot and just start blowing money sky high. And we know historically, after the Fed pivots, things fall apart and go down. So certainly plenty of reasons to do that. I think, in my opinion, my base case, kind of most probable case is if we do get some sort of sell-off, some sort of liquidity crisis, kind of some banking lockup, the Fed will overreact, and we'll probably see something similar to 2020, which is a sharp downturn followed by an amazing spike afterwards. And we could probably see that sometime, September, October, November, in that time period. And the reason why we say that is all of these things are sort of setting up. The market is pricing in for the Fed to start lowering rates, the pivot by that time. And we also know that when you raise interest rates like they've been doing, typically you don't see the effects of that for about 12 to 18 months. And so now we're about 14 months in. So by October, November, we're going to be right in the heart of that. So there's a bunch of reasons to think that. And that's a very likely scenario. Hey, this is Mark Moss, and you are watching Think Smart Education.